with the broader topic being fading the move. And this is something that's kind of essential to the contrarian's viewpoint. Fading the move, Mike, is just incorporating long and short strategies that go against the trend. You've probably faded the move before, correct?
I have. Sometimes it works, sometimes it doesn't. I will not be fading this move. But I will say the Santa rally, like everyone saw it coming, felt it was coming, but I don't think anyone saw this magnitude, like selling off Monday and then just 50 points, 60 points, 70 points every single day from that point on. 250 points from the bottom on last Monday, which is 5 trading days. Just absolutely crazy. But yeah, it does set up such interesting scenarios, especially when you dig under the hood, where like not every product is green today. There's a lot of them that are red. So if you are trying to play the extremes within these moves, I think you can find a lot of opportunities there.
Yeah, absolutely. And before we get into today's market and the potential within the Santa rally or other markets that we could fade, do you have any examples of the last time or a recent time, at least maybe in 2021, or let's do this, maybe the time in 2021 as we approach the end of the year that sticks out the most in your mind, Mike, that you remember fading the move and either working or not working?
Yeah, almost all of them are in actual small exchange products because I like to trade them from the long side. And mostly what I would do is I would just wait on the sidelines, wait for either Nick or Katie to be involved. And then once they started like really complaining about a position, then I would enter and I would look and be like, okay, we're at the lows of the year. Like I'm going to get long here. And, typically you see a bounce at some point and I would cover at that point. So we're looking at this right image here where we've got these green bars down to the downside. Maybe you get in the middle, maybe you paint the bottom if you're lucky, and then cover on the bounce to the upside. But I'm personally very comfortable fading sell-offs because if you're trading liquid products and you're trading products that you believe will be around forever, and especially here's the big kicker, if you're trading small enough to where you can hold the position forever, you put yourself in a really good spot to where time is no longer an issue and you can just wait until hopefully the market reverses. And as history has shown, especially within the E-minis, all of the sell-offs we've ever seen have reversed in that particular product. So
very true. Some very wise insight in there, a bunch of different nuggets. First of all, patience is key to a lot of patience in small size is essential to fading any move. I like how, you use the idea of like, whenever my friends are complaining about a position, that's when it's like, oh, okay, I've been patient enough. I can get into that position now. It's one of those things where like, whoever the guy that actually invented the light bulb and then Edison like took that idea, sometimes it doesn't pay to be the first person into a market, especially when you're fading a move, because if you're just fading every single, like the stock market moves continuously, right? Like every single minute, every hour, there's going to be a move higher or lower in the stock market. And if you're fading everything, that's probably not, you're going to get crossed up, you're going to get whipsawed all over the place. So when you are looking to fade either from the short or the long side, like Butler's talking about here, patience is key. Small size is key. We're looking at the small stocks here. If you're fading moves in E-mini S&Ps or NASDAQ, that gets out of hand pretty quickly, because the idea with fading the move, and I'm glad that you brought this up, is that like you need to be able to be comfortable with the idea that you're probably not going to paint the bottom. Like you say, like, or if you're selling, you're not going to sell the highs. When you fade a move, it means you're going against a trend, and 99 out of 100 times, probably even more than that, 999 times out of 1,000, the market's going to go through you a little bit. And so you need to be with a product and a patience level that you're okay with that. And I like how you bring up the example, because you're exactly right. You could have faded every sell-off in the stock market from when you were born until now, because we're back at all-time highs, and you would have been successful fading all of those sell-offs, buying those dips, so to speak. But if you got in too early, or you got into too big of a product, the market's going to move through you and you're going to have to get tapped out most likely. And so, yes, essential things there to fading the move. And this has been especially relevant from actually both directions in the last couple of months here. Since the start of November, we kind of stopped the upward trend through all-time highs in equities. In the last 2 months, we've been bouncing back and forth. But you, like you say, stay away from that short side. You pretty much only play fading the move from the long side.
Yeah. And there are exceptions to that, of course, but I'm just personally more comfortable, and especially like the more historical confirmations that we see that, like, when you have a big move to the downside, that it just gets bought immediately. That doesn't mean it's going to happen again like that next time, which is why I think, especially trading small enough, like these 3 dots I love here, where like maybe your contract size is 3 contracts. I'm not just going to go nuts and do all 3 at once. Maybe I'll do one at one point. And if we continue to move against my position, I'll enter in another. And really, especially with static delta positions, like small exchange products, you can really reduce your basis through multiple entry points versus just throwing it all and on one point trying to paint the bottom. And as we know, it's very, very, very difficult to paint the bottom all the time or paint the top all the time. And it's nearly impossible to do so. So it's tougher to do that versus kind of staggering your entry points.
Yeah, absolutely. And this is, in this example, you can see, if you faded the move there in early November from the short side, and I have in this visual element here, selling one, and then it goes a little higher, selling a second, and then selling a third, and then buying all of them back when the market reverses that trend. And then also the same example, just from the long side, buying one, buying a second, buying a third, scaling into fading any move is really a common practice in experienced traders, especially, everybody, when they first start out, they want to be a cowboy and start slinging around minis and even micros that are maybe too large for them. But starting with a small product and chopping that size up and getting different entry points is really huge, because when you are fading a move, it is a very popular and historically profitable strategy for contrarians. But like I say, and like you say, the market has to move through you most likely at some point. You're going against a trend. And the best thing that could happen is saying, hey, I'm going to sell 3 of these, or I'm looking to sell 3. I'm going to sell my first one here, and then I'm going to put in an offer higher, and then an offer even higher. And maybe I only get hit on 1 or 2 of those. That's great, because that means that the trend has reversed, and those 1 or 2 that I sold are now profitable, as opposed to, coming in with big size, saying I want to sell 3, and then selling them immediately where the market is currently now. Butler, where do I kind of figure out where I want to buy or sell? Looking at this in either direction, I, on a day-to-day basis, am looking at this from just the standard deviation perspective. And I talked a little bit about this. I don't know if it was you or a different personality here on the Small Stake Show, but I mean, this was common practice at the Board of Trade. People would turn their screens on. You'd be flat. We'd be only day trading. You'd be flat at the end of the day, flat going into the day, and turn your screens on, turn all of your trading technology and different stuff on, and immediately put bids and offers in at the standard deviation marks at either end of the market. And it usually was the scenario of like, oh, I'll sell 1 or buy 1 at the 1 standard deviation, and then put on another 1 or 2 at 2 standard deviations. And if we have an outlier day, the market really gets outside, then I'm ready to put on my full size. I mean, this is maybe a little heady of a way to look at it, but this is what is kind of in our minds, no matter whether you're looking at the actual math or not, right, Butler?
Yeah. And I think especially when you're chunking into these tranches of positions, the biggest benefit to doing this is the ability to have a profit where you would have had a scratch. Where like if you're layering into 3 contracts when you're at the 1 standard deviation to the downside, let's say you're trying to get long, and it continues to the downside and then eventually reverses back to where you entered, you're at a scratch. But if you did 1 contract at 1 standard deviation, another at 2 standard deviations, another at 3 standard deviations, if you get back to that 1 standard deviation mark, you have a profitable trade overall, because your first contract is going to be a scratch, but your other 2 are going to be profitable. And I think this also goes for closing positions too. I actually made a decision this morning where I had a call diagonal spread in AMD, and that's just a bullish position. And I actually looked at AMD being up 7 points today, and I was like, okay, I could make more on this position. If it reverses, I could lose all my gains. But let's look at, the expected move in the market and see what the current move is against that. And the 7-point move for just one day today was exceeding the entire expected move for the week. So I was like, okay, we're exceeding the expected move for the week. It's in my direction. I'm going to close this trade because I'm beating what I should expect to see on a directional standpoint, because I'm looking at this from a data standpoint.
Great points there. Yeah, it is. Price averaging is so huge for that scratch reason, like you started out with, which is like if I buy one at down 1 standard deviation, so the market's down $1.13, I buy one. Oh, now it's down 2 1/4, I buy a second. Oh, it's down 3.40, now I buy a third. If the market just gets back and closes within 2 standard deviations, which it does 95% of the time, I'm back at a scratch. If it gets back to 1 standard deviation, where it tends to close 68% of the time, I'm profitable. Not to mention, a lot of people will say, I want to get, I have size up to 5 units or 6 units. I can buy 1 at 1 standard deviation, 2 at 2, and then 3 at the third. And you kind of scale with the unlikeliness of the market getting out to those points. That's all more advanced stuff. But another great point is when you do fade a move, don't get stuck in this scenario of like, oh, I'm going to take something unreasonable out of this. Great example with AMD, where it's like that market maybe dipped, you bought some of it, and then you pitched it out for a profit up 7 percentage points because, looking at volatility and looking at numbers like we have in front of us here, 7 percentage points is really a good profit point. It's the same here where it's like if I faded the move and I bought the market down $1 and then bought some more down $2, I shouldn't then expect, oh, I'm going to take $5 or $6 out of this. It only moves $1 on a daily basis. So good point there. Now let's conclude with bouncing this out to multi-day trades. That fading the move can work intraday. There's plenty of examples every single day across different asset classes, not just stocks, of markets you could fade that move in, but it also works in any time frame, really. I just bounced this out to a week, but you can look at months, even years of getting positions on against that trend, banking on the market coming back to where it normally lives. And we can do this with our 5-day forecast that goes out to our community members as well, which is just, a projection of prices using realized volatility. And say, today is a good example. The stock market is up, and it's up outside of its normal daily range here on the first day of the week. I can sell one here, and then maybe tomorrow it kind of sits around these prices, but on Wednesday or Thursday, it shoots higher and gets through those highs again. I could get a second or third unit on, playing this market to come back in the next, not couple of hours, but couple of days, potentially weeks. I mean, this is probably more your bread and butter for fading any move, right?
Yeah. And I think just looking at these expected moves and structuring strategies around the expected moves or outside of the expected move, it's going to be different for every expiration you look at, like we're seeing here, because the more time you have, the more the higher the implied move is going to be because of the time that the market can move in one direction or another. But yeah, I think looking at these projections and not only determining entry points, but also exit points. And I like what you said about the previous slide, where like, if you get down to 3 standard deviations and you have 3 long contracts, you're not trying to play for a 3 standard deviation move to the upside. Like you're basically playing for a reversal to where you first entered, or maybe a little higher than that. So yeah, just keeping your expectations in check. But for newer traders, that can be harder without looking at this data. So just understanding how you can easily use this data to look at a market and be like, okay, this is exceeding the expected move to the upside or the downside. I'm going to fade this. Like that's what we're talking about here. And I think it's a super powerful way to trade rather than just looking at something without any context and being like, okay, I'm just going to throw this on because I feel like it.
Absolutely right. And I'm glad that you brought it all home with that comment there, because yeah, the whole idea is like, if I'm fading a move, I'm getting short into a big rally or I'm buying a big sell off, I'm doing this under the idea that like stuff in the short term, at least, is going to return to normal. And so then if my expectation is I'm fading a move, banking on a return to normalcy, and now I'm expecting an outlier in the other direction, that goes counterintuitive. I mean, fading a move in futures is essentially the same as the probably most popular retail trader strategy for options in the planet, which is selling a put into a down move. And when you sell a put into a down move, when volatility spikes, the market's selling off and you sell that put, you sell that insurance to someone else that the market's not going to move lower. All you're looking to do is make a couple $100 on that market rebounding. Same here with fading the move in futures. You're just going against the big outlier move of the day, banking on that market coming back to normal. So you don't sell that put, Butler, saying, oh, the market's down 5%. I'm going to sell a put and I'm going to try to make money on it rebounding 10, 20%. You sell that out of the money put just saying, I don't care if the market even falls a little bit more. I just want it to catch itself and kind of get out of this funk of downside activity. So great stuff here, man. Great stuff as always on the Monday edition of Small Stakes. You can catch Butler on other Tasty Trade programmings throughout the day. 11 o'clock Central is your usual spot, Monday through Friday. Also on Twitter, Mike Butler is tweeting out some interesting stuff, interesting trade ideas. So go follow him there. And you're all over YouTube too. You're actually the most popular YouTube personality, I think, from Tasty Trade with Mike and his whiteboard. If you haven't checked it out, best way to learn options.
Yeah, it's a very visual way, and hopefully that's helpful. And yeah, it's an older stuff, but old but good.
Evergreen content over there from Mike Butler. Thanks so much for joining us here, buddy. And now, next, we have Splash into Futures with Pete Momat. He's back. We're going to open up the platforms and fade some moves ourselves. Thanks so much for watching, everybody. Peace.